When trading the financial markets, you have to have it in mind that you're going to make a lot of mistakes. And if you don't learn from those mistakes, it's actually really going to be bad for your trading journey. Note, guys, after taking many trades across different pairs, it became evident to me that other blocks operate more effectively and generate consistent profit when accompanied with certain market conditions. In this video, we're going to simplify the concept of order blocks in trading. We're going to explain a rule-based strategy towards the order blocks that are going to be respected by the market. We will further explain what conditions are required for a valid order block and how to effectively mark and treat them on the charts. Also, the internal and external structure concepts that are required to combine with order block concepts. So, if this is what you're really interested in, just stay tuned, watch this video to the very end, and also hit the like button and subscribe to this YouTube channel. Welcome back. Let's dive right into it. Generally, order blocks are areas where buying and selling pressure resides. The market rejects this area once, so when it returns back, it might react to the area again. Note, not every order block is a supply or demand level, but not every supply or demand area qualifies to be what an order block. Let me show you guys how and what I mean by that. Every reaction to a price level creates a supply or demand area. It shows that traders have opened massive buy or sell positions, which causes significant price movement. So when price returns to this level, we closely monitor the price action to find the possible trading opportunities. But trading every single supply or demand area would not be effective. Through time and witnessing repetitive pattern on the chart, we have noticed that when supply and demand areas are accompanied by certain conditions, the chances of them working out or the chances of the trade working in your favor increases. One of the key supply and demand area is order block. So first, what are the requirements to consider an area a valid order block to trade? Then we'll look at how effectively to mark them on the charts. Let's look at the rule of a valid order block. The first rule is what? Having inefficiency. Note, inefficiency, imbalance, fair value gap are highly similar concepts. When large amounts of money enter the market and create an imbalance between buyers and sellers, the fair value gap pattern forms between the candles, creating a phase of inefficiency. This movement that has entered the market has affected the price, and price often return back to areas to accumulate the remaining orders. The second rule of having a valid order block is breaking market structure in a bullish scenario. When price movement breaks the latest market structure and closes above the recent high, the origin of the price movement becomes highly important. It shows that the demand area that created this movement is not an ordinary level, but an influential area in market structure. With that being said, a supply or demand area is considered a valid order block that has break structure to the upside. Applying the same concept to the bearish scenario, when price movement break the latest market structure to the downside, the origin of the price movement become highly important. It shows that the supply area that created this movement is not an ordinary level, but an influential zone in the market structure. So these demand areas are considered valid order block. Now we're going to be looking at the third rule of considering a valid order block. Liquidity is where the stop loss reside. And when you combine liquidity concept with order block, it enhances your chances on the understanding market structure, and it provides valuable information for strategic decision making, and it gives you opportunity to take better trades. There are three common liquidity graph patterns that happens every day on the chart, Forming each one before reaching our order block increases our chance of success for our trades. Starting with the first one, the first liquidity gap pattern is when we have a fair value gap and an order block precisely below the zone. There is a high chance that the first demand area becomes a victim of the liquidity gap movement, and then the price takes off when it reaches our order block zone. This will make our order block zone even more powerful because right now the market contains the required liquidity for future movement. So right now I'm going to mark the demand zone, right? Just going to mark it out. We have this demand zone here, right, which I've marked. And clearly you can see that the market came to it, but did not respect that demand zone. Why? Because of the fair value gap which we have right here. Because of the fair value gap which we have right here, guys. Okay, so you're looking at that fair value gap. Let me just finish marking it. Right, you can see that fair value gap. That means the market has to trade into that fair value gap and respect the demand zone, which is underlying the fair value gap. Right, you see how the market traded into the fair value gap, right? And then from here, you see market went all the way, and that could have given you probably like a 1:3 risks to reward. Sort of giving you like a 1:3 risks to reward ratio. So you see that, guys. Stop loss just right here, and then you aim for a 1:3. So you see that, guys. So guys, before placing any trade, you have to actually note this important point, okay? All right, you have to know the conditions of the market. So, guys, the second method actually involves what? Equal highs and lows. The equal highs and lows for uptrend and for downtrend. But in this scenario, we're looking at an uptrend. So in a case where we have equal lows like we have here, that is an interesting area for support, for typical support and resistance traders. But for we, the smart money concept traders, we are looking at the order block which we have right here. We are looking at this order block right here. So what we are actually waiting for the market to do is to actually come and grab the liquidity line below this area. Then we can actually target the highs. Hope you understand that. So here is the area where we actually going to be looking for our buys. So at this point, we just take our buys here and then a stop loss just slightly below, and we go for at least we can target this first highs and this second highs. That's very good risk to reward ratio trades. So that's what we should be looking for. So right now, guys, applying the same concept to the bearish scenario, you can clearly see that we have was demand, our order block here, which is the supply zone. So the market actually grabbed the liquidity around this area. There was a liquidity grab around this area. So the market went to the supply zone, and there you can clearly take your sales from there and all the way to this area for your targets, guys. So you see how the strategy works perfectly well. I'm going to show you guys how to actually apply them on the live chat. So just stay tuned. So now, guys, we are going to be looking at an example here where we have equal lows, all right, equal highs, and then the liquidity grab. So right here, let me just do a little breakdown of this market. All right, so what we're having here, we're having a market pushing to the upside, okay? So there was what? A liquidity grab below here was since the market invalidated this place, look how this low. I created what? Already from here, we can see that the market is actually failing to actually continue to the upside. And when we finally took out this major low, that signifies that the market was actually ready for a downtrend. So we had a little retracement to somewhere here. The market actually respected it by falling all the way down to this area before we have our corrective move to our supply zone, right? Our other block. So right now, I want you guys to look at this area where we have our equal highs. That is an example we have actually looked at, right? But we did not look at it on the main chart. We have our equal highs here, as you can clearly see. All right. So, and the market actually went ahead to grab the liquidity. Market went ahead, then to grab the liquidity above that area. So finally, drop into the downside. So you see here, let's mark our zone. So clearly now we have actually marked our zone, guys. All right, and I'll be showing you guys how to actually mark your zones in this particular video. So you see how the market went to that area, right? And in this particular case, you would have just gone for your 1:3, right? For me, I would have preferred to enter after this candle close, right? That gives me confirmation, right? And more tighter stop loss, and then all the way to the downside. See this, guys. So that's a 1:5 risk to reward ratio. And what we're going to do now is we're just going to go ahead and mark out our other blocks. I'm going to be showing you how to actually do that now, how to mark your order blocks. So let's say the market is moving to the upside in an uptrend. So what you're going to be doing is you're going to be marking the order block. And the order block is the last bearish candle, like in this particular case. Here, you can clearly see that this is our order block. These are order block. So here again, we have our order block here. So this area is our order block. So what we're going to do now is we're just going to go ahead and mark that order block. So after marking it out, what do? You wait for the market to actually return back to this area before you take your buys. So the market has to return back to this area. The market has to return back to this area. Then you take your buys to the upside. So that's the main purpose of the order block. So when the market returns to that area, when the market returns to this area, what do? You take your buys from here. All right, your stop loss just slightly below. All right, and you aim for the highs. All right, so in this particular case, I've just made a risk to reward ratio of 1:5 risk to reward. So it is just that simple, guys. So now we're going to be looking at the bearish scenario. Okay, we're going to be looking at the bearish scenario. That's the next thing we have to look at. Just that in this particular case, we are looking at the opposite of what we are looking at there. So here is our other block. Right here we have our other block, okay, and then the same thing here. Right now, what we're gonna do is we're just gonna go ahead and mark this other block, okay. We're gonna go ahead and mark the block. Right, just give me a moment, guys. Let me just adjust some parameters. Okay, go ahead and adjust this. All right, so that's okay now. Okay, this is okay. Right, so here is our block. So what you have to do in this particular case, you wait for price to get back to any of the zone, then you take your sales from there, right? So there's some way to actually look for confirmation. We're going to be looking at that. If we don't look at it in this video, we're going to be looking at it in the next video, right? So you wait for the market to get to the zone, so and then you sell all the way from there back down, right? So once you do that, you just place your sales there. Sorry. You just place your cells. So you just place your cells here. Stop loss is just slightly, you place your cells there. Stop loss is just slightly above this supply our order block was just slightly above those candles there. So same thing applies to this. All right, so same thing applies to this. You take your cells here, right? Stop losses just a few pips above. Then you can just go for 1:3, 1:4, risk to reward ratio, just as you please, guys. So this is actually very simple, guys. This is very, very simple, easy to implement strategy. Now, guys, based on the market structure concept, three kinds of order blocks exist in the market: continuation, reversal, and ranging. We are looking at a typical uptrend now, all right, where the market is actually making highs, lows, and then highs and lows, highs and lows. So, by looking at the order block here, all right, what you can see here, this is an order block, all right. For an uptrend, what you're going to be waiting for is the market to actually come back to any of those levels. All right. When the market comes to those levels, you can actually buy back from here all the way up. Okay. Depending on what you actually see here. All right. You can actually wait for a change of character, another continuation pattern, then you actually buy and you target up. So that's the main reason why we actually use the continuation pattern. All right. When you buy from there, your stop loss should just be slightly below. The stop loss should just be slightly below, and then you target the highs, guys. So that's that. All right. That's that, guys. So your stop loss just slightly below and the highs. So see that? It's just as simple as that, guys. I'll be teaching you guys the entry techniques in my next video. Looking at the chart right now, you can clearly see that the market is moving to the upside. Okay, we have the high highs and higher lows. All right, and the other blocks have been formed. Each other block gives us an opportunity to get an entry to the upside. Okay, it gives us an opportunity for a buy entry. You understand? Like here, we have another block. Let's start with here. We have another block, the market traded into it. We get our buy entries after the change of character, and the market went to the upside. So you just capitalize on that. All right. So you capitalize on the other block. Right here, we have what? A change of character. All right. A change of character automatically what creates a what supply zone. All right. We have our supply zone being formed here, which is also an order block. You wait for the market to trade into the supply zone, and then you take your sales. But in this particular case, the market could not trade there. But rather, what we have here, we have what? A break of what? Market structure. A break of market structure to the downside. A break of market structure to the downside. So that's what we have here. That's what we're looking at here. All right. Break of market structure to the downside. So in that particular case, what you're going to do, that automatically what creates what? A supply zone. All right. That automatically creates a supply zone, which we have here. Right. That automatically creates a supply zone. Let me just mark it out. That automatically creates a supply zone, which we have here. All right. So what you're going to wait for is what we have here is we have equal what highs. And then what you automatically wait for in this particular point in time is you wait for what a liquidity grab. You wait for a liquidity grab. So after the liquidity grab, you can clearly take your sell. You can clearly take your sales from there. Right. So see, after the liquidity grab, the market automatically did what? Market automatically traded into a supply zone. Then from there, you can clearly take your trades. After that, the stop loss just slightly above the supply zone, and then you can clearly see how the market traded to the downside. Look at that. Look at that. So you have made this massive profit, guys. So that's how the strategy works, guys. So guys, we're going to be looking at the next order block, which is the ranging order block. This other block is seen to occur when the market is actually in the trending phase to the upside or to the downside. So in that scenario, what you expect to see is that the market is actually pushing to the upside, then it actually pauses for a while, then you have the range being formed. All right, market stays in that range for a couple of while, then break to the upside. All right, so you expect what you're actually expecting in this particular case, you're actually expecting the market to come back to that order block. All right, for the retest. Okay, the market comes back to that order block for the retest, then you actually take your entries and expect the market to continue to the upside. So right here, you need a minimum of 4 candles for that order block to actually be clarified. You need a minimum of 4 candles, right? So it's always pretty obvious, okay, because you see the clusters of candles being formed, and then you actually wait for the breakout, and then the market returns back to our order block, and then you take your buy entries to the upside. So this is a typical example of what you should actually expect. All right, so now this is actually theoretical, but I'll just go to the chart to actually show you exactly what it actually looks like. All right, so now let's, guys, you see here, let me just pick it out. Okay, let me just delete. You see, I actually took that trade, which I'll be showing you guys that clean evidence, guys. So see, and the trade is actually still running. You see, we have a cluster of candles here, and what happened? The market actually broke to the upside, returned back to the other block. All right, you can actually include that part, but let's focus on what was actually happening here. So you see, the market actually broke to the upside. We have our break to the upside, okay, return to the other block, and then boom to the upside. Right, look at that. That's actually pretty, and you're just gone for like 1:3, 1:4 risk to reward ratio. So this is actually pretty massive. I'll be showing you guys my entries on this particular trade. All right, so that's actually beautiful. It's actually amazing. If you like the video, subscribe to the YouTube channel, also follow us on the Telegram channel. So see you guys in my next video.